Good evening, viewers. This is your tutor CPA Charles Cafe, and today we are going to resume with our series of financial reporting. And as a precursor for what we did last time, we finished IAS 16 and we did some computations. And I'm very sure if you try to do some more numbers on that standard, you'll be able to understand more and be able to do more numbers as you can be seen from the question banks. Now for today, we are going to look at IAS 40 and we are going to start with our first computation, and we had a trial number that was May 2017, but it is the same like June. It is June / May 2017, and it's going to be question 3, where we are going to be looking at how we are going to be solving some questions that are in relation to IAS 40 investment property. And the reason why I chose this question, it has some aspect of where we are going to be looking at items or properties that are close to IAS 16, and if you didn't get more on what we discussed in IAS 16, you can use it as a precursor and be able to understand more and more of these standards. We said it is going to be May 2017, and my emphasis here is basically on question 3, part B. So we can try to look at how question 3 says, and we see what we can do from that. This is a whole question paper, and our question 3 starts from there, as you can see from the screen. But my emphasis is mainly on part B, because part A is more or less of what we covered within our theoretical aspects that we handled. We did a first video that was giving theoretical aspect, but here we are now looking at question papers and we are picking some questions to be able to enhance our understanding the standard. Question 3, without wasting more time, says, question 3 part A says IAS 40 investment property defines investment property as property in bracket land or building or part of the building or both, held to earn rentals or for capital appreciation or both. This is basically the definition we gave in our first video or the notes we have, and they continue to say it further specifies the conditions for recognition and measurement of assets classified as investment property. The required says discuss the conditions that should be satisfied for an investment property to be recognized as an asset in the financial statements, and exceptions of the assets that should not be classified under investment property. When you take a look at this question, This is basically some of the things we discussed earlier in the first video, where we try to look at what are some of the things that are included within the scope of IAS 40, or what are the limitations, because when you try to look at the exemptions of assets that shouldn't be classified under investment property, those are the examples we looked at. What are some of the assets that are not falling into the investment property? And we looked over 4 of them, and that's basically what this question wants. And the other item they want is the recognition criteria. How do you know that you have an investment property? That's basically the recognition criteria. We said for any asset, even from the conceptual framework, for any asset we are saying that we should be expecting something from the asset. Those are then we can also be able to determine the cost of that asset reliably. When we can be able to determine the cost of the asset. The recognition criteria, as we said, it's probable that future economic benefits associated with the asset will flow to the entity. What this means actually, if I may give a clear description of this, is that when you're buying an asset, we are buying assets that we are going to be using as a business to generate revenue. So if you are acquiring any asset, whether long term, whether short term, that asset should be, or must, actually it is not even should, it is a must, that it's supposed to be adding something to add value to the organization. If it doesn't add any value to the organization, then you are just holding that asset for nothing, because it's not helping the organization to grow. Then the other one, of course, even the cost, its cost, it should be having a monetary value that you can attach, or that you can record in the books, because when you're preparing financial statements, we always record monetary values. If at all you can't determine the cost of the asset, then it means you can't recognize it as an asset. There are basically 2 recognition criteria, and if you need more clarity on them, just try to go back and check our first video of IAS 40. We explained all that is needed as far as the theoretical aspects is concerned. We try to look at what are some of the properties that are not falling into or that can't be classified as investment properties. We try to look at one of them. We say the owner occupied properties, or the properties that are being used by the organization itself to generate income within the organization. And we say those items are accounted for under IAS 16, that is property, plant, and equipment. The other item we looked at was the properties that are being used, or that are sold out in the normal course of business. It's not always a must that whenever we are talking about the non-current assets, we are meaning these non-current assets, and you try to say that they are going to be long-term. Some of them you may find that these long-term assets, they are inventories to certain organizations. If, let's say, it is a real estate company and they are buying land and building, they buy, they renovate, and they sell. So that's their inventory. So it's not a must that whenever we are talking about the buildings, we are supposed to be talking about the long-term assets. Sometimes we find that those assets are the ones that have been sold in the normal course of business. So if they are sold in the normal course of business, even though they are long-term, we call those ones as the inventory, or they're supposed to be accounted for under IAS 2, that is the inventory. Then we have also properties constructed on behalf of customers. And these may look at some example, maybe these construction companies. When these construction companies are building certain structures or buildings, it's not that those structures are going to be owned by the construction company. They are just helping they're just doing that as their normal work they do in a daily, but it doesn't necessarily mean that those assets are going to be theirs. So we treat that one as revenue from contracts with customers under, that is IFRS 15. Then the last one we looked at these assets that have been leased out under finance lease. We said finance leases, these are basically assets that have been given out, and it's like, if let's say the asset had a useful life of maybe 20 years, you find that the person has leased that asset maybe for 19 years. You find that it's more or less that the owner has given up control of it. So if there are those, then we can't classify those under investment property. So that's basically what they wanted, and we are not going to go deep into that. That's basically just a precursor of what we were supposed to do. But what you have to put in mind as a reminder that whenever we are talking about these assets, these long-term assets, we are basically looking at the purpose. What are they being used for? Is mostly the one of the key item where you can determine that this asset is going to be accounted for under this standard, depending on the purpose or what that asset has been put to. Then you can be able to understand how you're going to be accounting for that asset depending on its use or the purpose of the asset. That's basically what we can talk about. Then question 3B, part B is one which I'm interested in, because for it has some computations, and that's basically what we are going to be looking at for today. Part B says Nyumbani Limited acquired two properties of land one for 100 million on 1st January 2015, and the other on 31st December 2015 for 80 million. Land 1 was for 100 million. It was acquired in January 2015, and land 2 was acquired on 31st December 2015 at 80 million. They're saying that during the year ended 31st December 2016, Nyumbani Limited constructed its head offices valued at 120 million on the land whose cost was 80 million, and nothing has yet been decided on what it should use the land that cost shillings 100 million. What this statement means is that the second land that was bought on 31st December 2015, it is that land that they used to construct a head office that valued at 120 million. It means we have three properties. We have land 1, we have land 2, and we have the head office or the building that was constructed. Then they are saying that the prices of land in Uganda and Kampala in particular are increasing day by day because of high demand and inflation. Experts estimate that the average inflation rate of the prices of land is 15% per annum, meaning every year it is increasing by 15%. What you have to understand in this statement is that these prices are increasing because of the inflation, and inflation is the persistent increase in the general price levels and all that, as you studied it in economics or economic environment. But you have also to understand that it doesn't necessarily mean that every time land is going to be, all these assets are going to be increasing in value. This time around, they have been saying there is an inflation. You may find that in the next question, they may be saying that land has been deflating, because the opposite of inflation is deflation, meaning persistent fall in the general price levels. So you make sure you understand most of the things, and we try to eliminate some of the English problems that make that, because you may find that the standard is a bit tricky, and even some of the things you have not understood them. So if it is a deflation, it means the prices are going to be reducing. So if these prices are going to be increasing, we are expecting that either we are going to be having a gain or a loss. But mainly when these prices are increasing, we are going to be receiving, or we are going to be seeing a gain, especially when the assets are depreciable or are non-depreciable, as we are going to be seeing. They say the inflation is 15% per annum. Then the required part 1, question 3, part B, Roman 1 says discuss the 2 measurement bases used in ascertaining the value of an investment property in accordance with IAS 40. This is something that we looked at. If you remember very well, that those are the things we started with, the measurement bases. And whenever we are talking about these measurement bases, we are talking about these alternative means. These are just the alternative means that we can use to record the asset or the value of the asset. Are we going to be maintaining the cost model, or we are going to be using, because basically when you are saying are we going to be using the cost model, meaning are we going to be maintaining the cost, the initial cost we incurred when we are acquiring these costs. That's what we actually incurred initially, or at the initial measurement. Or we are going to be using a different model, which is the fair value, because we said under IAS 40 we are using two measurement basis. We are either keeping these assets at their cost. In other words, we are just using their cost model, or we are using the fair value. And fair value is the estimated marketing price, meaning it is what we can actually get from the market if at all we are dispose these assets. Because as the word suggests, it is a fair value. It means when it goes in the market, it is an active market and everything is free and fair. So those are basically the things they wanted in that part one, and you could explain the cost model and the fair value. The cost model, we said we maintain the cost, but we also take into account the accumulated depreciation and accumulated impairment losses when we are determining the carrying amount. Because that's basically, these things you don't need to cram them. You find that if, let's say, you have bought an asset, let's say, of 10 million, and you find that by the end of the year, are we going to be maintaining the cost of the 10 million that we paid to acquire the asset, or we are going to be adjusting it with its recoverable or its market prices, what we can actually recover if at all we are to sell those assets in the market at that very period. Those are basically the things they wanted there, but my interest is in this Roman 2, which says, given that the two properties of land are located in Kampala and that Nyumbani Limited uses a fair value measurement in valuing its land, this is actually giving even the answers, because what Nyumbani Limited uses is a fair value model, which was actually the answer that you are supposed to put in the first Roman 1. So that's basically what they are saying. They are saying we are going to be using the fair value, meaning we are going to be using the estimated marketing prices. We are not going to be maintaining the cost of the asset. And they are continuing to say that and depreciates its building at a rate of 5% annually on a straight line basis. Then they are saying, show how the above transactions will be recognized in the financial statements for the year ended 31st December 2016, giving extracts for the financial statements. Having looked at that question, and we have actually, if you try to analyze what are some of the things that you may take out from this question, and they have given it 13 marks. What you have to understand within this asset, for any non-current asset that you are going to be working on, the first thing you have to understand is what is the purpose of the asset. Because if you understand what the asset does or what the company is using that asset for, you can be able to understand which standard are you going to be using to account for that asset. So before we think of any values that we are going to record, we need to first know the standard we are going to be using to account for those assets. And the only way we can do that is first knowing what is the purpose of those assets that have been given in the question. And when you try to look at the question in detail, this part being Nyumbani Limited, you will see that they are saying Nyumbani Limited acquired 2 properties of land. One for 100 million on 1st January 2015, and another land 2 on 31st December 2015 for 80 million. You will see that even during the year, because they are saying during the year ended 31st December 2016, they also constructed a building, or they constructed a head office. It means that this head office, actually they are constructing an office premises, where they are going to be operating. It is their head office. It means it is now turning from being an investment property to PPE, that is property, plant and equipment, because we said in the property, plant and equipment, that's where we have the owner occupation. It means that this organization is going to be using this building they are constructing. It means that since they are constructing this building and they are going to be using that building as a head office, it means even the land is going to be occupied by the head office, which means that this land where they constructed this building, both of them, we are going to be accounting for them under IAS 16. And the reason is simple, because they are all of it is going to be used as head office, or they are going to be constructing an administrative block that which brings a very nice property of IAS 16, that is PPE. Because we said under IAS 40 investment property that these the assets that are falling in that category, for them they are going to be used for earning rental income, and they are going to be used for capital appreciation, or they are going to be used for both. So if it is not one of those 3 criteria, we can't categorize them under IAS 40. So now we can say that the land which costed the 80 million, because it is that land that costed 80 million where they used it to construct the head office. We have confirmed that we are going to be accounting for that building they constructed the head office under IAS 16 PPE. And also the land itself is going to be accounted for under IAS 16 PPE, because it is going to be used for administrative purposes or owner occupation. Then we try to look at this land 1, the remaining land 1. This land 1, we are seeing that it was acquired on 1st January 2015 at 100 million. But we are seeing that the purpose of this land, because they are saying here that the purpose of this land is not yet decided. So if the purpose is not yet decided, it means it's more or less, or it's assumed that that land is going to be used for earning, for capital appreciation. Of course, for capital appreciation, those are you buy land, you leave it there. Actually, you don't even know what you're going to be doing. And in that sense, it means by the time you realize what you're going to be doing with that asset, it has accumulated value, or its value has now increased. So that's basically what we mean by capital appreciation. Since the purpose wasn't known, you can't classify that under PPE, because for PPE we are very sure that the assets that are going to be there are going to be used for administration, or they are going to be used in the production or supply of goods and services. But here the purpose is not known, so it is now going to be assumed that that asset was bought for it to increase in value. Then when you try to look at this in this Roman 2, they gave us the measurement bases they used. They said they are going to be using fair value. But I want you to understand something. They have told us that they are going to be using fair value as the measurement base. But we have to understand that under IAS 16 PPE, because we have agreed that the other land that was costing 80 million and the building, they are going to be accounted for under IAS 16 PPE. So we have to know that what are the measurement bases that are there in IAS 16 PPE, or property, plant and equipment. When you try to look at the models that are going to be used under IAS 16, you don't see there any fair value model. We only use the cost model and the revaluation model under IAS 16 PPE. So it means that we are going to look at those two models that are used under IAS 16. Which one represents the market value? Because we say the fair value is more or less the estimated market value or the market prices. So we are going to be using now the revaluation, because the revaluation is more or less, is almost the same as the fair value, because all of them, they try to look at what they can actually get after revaluing. And whenever they are doing these revaluations, most of the times they consider factors that are within the market whenever they are doing the revaluation. So here, if you are to use the cost model, you are going to be off. This one, we are going to be using the revaluation model when you're accounting for the other assets that are going to be falling under under property, plant and equipment. But for these items that are going to be under investment property, we are going to account for them using the fair value model as they have suggested. And we've seen that it is only land 1 that is going to be falling into that. So basically, that's how we do the analysis. After doing that analysis and you have analyzed everything, then you can try to go ahead and start calculating these numbers. We said one of the things you look at is the purpose. The second item you look at the model that has been used, or the model that has been adapted by the organization to account for those assets. And the other one, we also look at the time, of course, the period they have acquired the asset, and the cost, or the money they have paid. Those are the things we consider. So one of the emphasis, or one of the things I want to emphasize here, is that this paper is more or less Actually, it's not all that you are going to be computing, that whenever we are talking about accounting, you are going to be doing computations only. Because for this number, if you are to do only the computation, you couldn't get all these 13 marks, because you can't compute these figures and you start saying you will be able to earn these 13 marks. What you have to first give is you explain what we've been explaining, and don't be too wordy. Make sure you write something that is precise and concise. Of course, you write something that is not too much, but at least it is making a point. And the things we are going to be writing, they are going to be the purpose and where it is going to be accounted for, and why is it accounted for there. Those are the things you put. If you find that you are answering those 3 questions, it means you have done it in the right way. We said first you talk about the purpose of the asset. The second one, we try to look at the model that you are going to be using and which standard is going to be used to account for that and why. Those are the things you're supposed, actually the key items you're supposed to be following whenever you are answering some of these questions, especially on non-current assets. So let's try to look at the Excel. We go to the Excel and we try to do the computations and we see what we can do. Having read through what we actually have analyzed, I'm going to first make a summary of what we have actually discussed and we see what we can do. This is the same question. I just copied it, but it is the same question. Can I go to the other slide and we'll try to look at what we can do. We'll go to the next one and we'll try to see what we can do. The sheet, then another sheet, and we try to see what we can be doing from this. Okay. We try to look at the summary. We said the land one, we first make summary. The land one, we start with the land one. We said this land one was acquired on 1st January 2015 at the value. We said the value was 100 million. Permit me to use M. Okay, let me put it here. These values are going to be in millions. Millions. They are in UGX, but you can put any currency sign you want, but they are in UGX or Ugandan shillings. We said now we'll go to the purpose. What is the purpose of the asset? And the purpose was not yet decided, and we agreed that this is going to be accounted for. Not yet decided. We agreed that this is going to be accounted for under IAS 40, investment property. Then we try to look at the model. The model they used, they told us the model is fair value model. That is the estimated market price. Try to zoom in and be able to see what we are writing. Then they have told us that we have even the inflation. The inflation was 15%. But as I said, you make sure you understand what we are writing, because in the other questions you may find that they have given you a deflation, which means there was a fall in the value. So you'll be able to understand that. Okay. So when you have done that, this actually is 15% per annum. It's per annum, meaning every year the values are going to be increasing by 15%. But when you try to look at this question, the question says we are looking for the financial statements that are for the year ended 31st December 2016. When you try to look at this, you see that this asset was bought on 1st January 2015. It means we are reporting the reporting date we are reporting for 31st December 2016. It means if we have these figures, since it is land, we are not going to depreciate it. But take note, if it was a depreciable asset, you first compute the depreciation, because they had given us in the question there is a depreciation. They have given us that actually it is only the building that is depreciated for 5%. Actually, I will explain more when we reach the building. But if this, take note here, if this has been a depreciable asset, if it wasn't land, you first depreciate, you get the carrying amount as at 31st December 2016. It will be that we are going to be taking to the, actually you first compute the depreciation before you adjust the values, the inflation, but after that you compute the depreciation that is going to be taken to the income statement, because they have also told us to prepare the extracts for financial statements. We said in the previous videos that these extracts, they mean These extracts actually they just want only the financial statement of financial position and the balance sheet. Actually, it is a balance sheet and the income statement. So, having done that, then we try to answer the question. Of course, we said this is going to be a mixture of computation and theoretical aspects. So here for land one, we have to start explaining how are we going to be accounting for this. We are saying that land one will be accounted for under IAS 40, investment property. Then you put a reason why is it going to be accounted for under investment property, since nothing has been decided, nothing had yet been decided regarding its purpose. Therefore, or thus, it's deemed or it's assumed that at that point it was being held for capital appreciation. Stop, that's enough. Just one line or two lines is enough to explain what is needed. Actually, maybe you can add that the land, we add the model that is going to be used. The land will be measured at fair value, because that's what actually, even if this one you don't put it, because that's what actually they have given us in the question, because they said Nyumban Limited is using a fair value measurement base. So if you're going to be using the fair value, then we need to know what is going to be the fair value, because this asset was acquired on 1st January 2015. Then at the end of the year, that is as at 31st December 2015, what is the fair value of that asset? That's basically what we are going to be looking for. Then we look for the fair value. Fair value as at 31st December 2015. We first look for 2015. because they have told us the inflation rate is 15% per annum. It means from 1st January to 2015 to 31st December 2015, that's 1 year. It means the asset is going to increase in value by 15%. So the value is going to be 100 million, 100 million plus we add 15% multiply by the 100 million. Which will give us 115 million. This is going to be the value of the asset as at 31st December 2015. If at all we had depreciation, if at all this was a depreciable asset, we first depreciate this asset. But since it wasn't a depreciable asset, then we just take that. It means if at all in the question we are asked for 2 years, we could record this figure and also record the one as 31st, if at all we are asked for 2 years. But since we were asked for only 1 year, which ended 31st December 2016, this figure is useless. We are not going to put these figures in our financials, because the financials we are going to be preparing, they are for the year ended 31st December 2016, meaning that if the year is ending 31st December 2016, it must have started 1st January 2016. So that's basically what we have. If this is going to be the value of the asset as at 31st December 2015, then we have also to look at what are we going to be accounting for in that year as far as those figures are concerned. We have to look for the changes in the value. Another person here could say that this will be equal sign, it will be 100 million. Then you just multiply by 50, you just multiply by 1.15, which is the same as 100 plus 15, that is 115 over 100. If you multiply by that, you'll be getting the same answer as that. So that's that. And so that is it. Can now go to, because when you try to remove this, you'll be getting the same answer as we got this. So basically, when you try to look at, we said we now we have to get, since it is now going to be an increase, since we said it is going to be inflated, meaning we have to compute for the increase in the value of the asset. And how are we going to be getting? We get the cost, the new cost or the fair value, which is the 115 million minus the 100 million. This will give us 15 million, and this 15 million will be a debit. We are debiting the asset, which is the land. Can just say investment property, which is the land 1, with 15 million, and we credit our profit and loss. Profit or loss account. This is going to be in the names of other incomes, or the gain. Got a gain in the asset. The reason why this is going to be going to the profit and loss is because this fair value, these changes in the fair value is realized. Realized means that if at all you are to go to the market, that's the exact amount you are going to be receiving. You bought the asset at 10 million, but if you are to sell it, you are going to get actually 15 million. But if we are using a revaluation model, we could be taking that one as, we could be taking that revaluation gain to the OCI, or statement of other comprehensive income, which comes after the net profit. So we are going to look at how you can be able to account those ones when we try to look at the IAS 16 PPE. So that's basically for this, for that year 1. So now we try to look at what are the figures that we are going to be having, the fair value for the year. Now we are looking for the fair value because this fair value we have is for 2015, but we need the fair value as at 31st December 2016. This fair value as at that date is going to be, now we are starting with the figure we had. This figure, if at all we are computing for 2015, this one is the one we could take to the balance sheet. So we are starting with that figure, which is 115 million times the 15%. They say the inflation it is this plus 115 million. This one is in the bracket. There we are going to be getting these figures. We are going to be getting 132.25 million. That's going to be the value as at 31st December 2016. So it is this figure that we are going to be taking to the balance sheet of this date. But again, here we have also to compute the increase in the price, or in the value of the asset. That increase in the value of the asset, we said we are going to be getting the amount we've got, which is 132.25 million, we less the 115, which is the previous figure of, because this value we have here, 31st December 2015, is going to be the same figure as at 1st January 2016. That's why we are lessing to get the balance. So when you do that, you'll be having 17.25 million. And this one is going to be a debit. It's going to be a debit to the investment property. 17.25 million. Then a credit to the profit or loss account in the names of gain or other incomes. Meaning this one is going to come after you've computed the gross profit. We are going to be adding a change or a gain, a fair value gain. This one is going to be taken to the income statement, and this figure will be taken to the balance sheet. So we can now go to land 2 and you try to compute the land 2. We've done land 1, and for now we can go to land 2. This land 2 and land 2 said it's going to be accounted for under PPE because it was used as head office. You can make summary. It was acquired when? It was acquired on 31st. Was acquired on 31st December 20. Was acquired on 31st December 2015. The price was 80 million. Then we try to look at what is the purpose. What was the purpose of that asset? The purpose was head office. Meaning, if it was head office, it is the same. The same we could say it was used for own occupation or administrative. Then the model, of course, the model here they are going to be using is the model. They said it is a fair value, but since we don't have a fair value in IAS 16, we are going to be using revaluation model. I explained that the reason why we are going to be using the revaluation model. Then we can do some small explanation because we said this is a combination of computation and theory. We see you're saying land 2 will be accounted for under IAS 16 PPE. Permit me to use that since it was was used for construction of the head office building. Head office. Here you can put owner occupation. That is the reason why it's going to be accounted for under then you can also add that it will be measured in the measurement it will be measured at marketing value. That's the fair value. The market value, of course, the market value in this term is called the revalued amount. Say the revalued amount is the amount you get after the asset has been revalued, or the estimated market price. So now we need to compute the revalued amount. The revalued amount is going to be inflated because the inflation is there. When you try to look at the revalued amount, the revalued amount is going to be equaling to, the cost was 80 million. Now this revalued amount is going to be as at, since this asset was bought on 31st December 2015, it means the revalued amount as, let me add as at 31st December 2016. It's going to be 80 million is 80 million plus the 15%. And when you do that, we are going to be getting 92 million. This one will give us 92 million. Having gotten that, then we have to look for another item that we are going to be accounting for in this IAS 16 PPE, which we call either a revaluation gain or a revaluation loss. But since these items have been inflated, then we are going to be having a revaluation gain. And this revaluation gain, revaluation gain is going to be equaling to the 92 million minus the 80 million, which will give us 12 million. And that 12 million, how is it going to be accounted for? It's going to be a debit this time around. It's not an investment property, it is a PPE. Let me to use PPE. In terms of land 2, I'll put land 2. Then 12 million, then a credit. This time around, we are not taking it to profit and loss because This 12 million is not actually realized. It is just a revaluation. We said whenever we get a revaluation, it's not actually an income that we can actually get it, but it is just an estimate that if we go on the market, we may get this item at this price. So this one is going to be taken to the OCI, or other comprehensive income. And this other comprehensive income is coming as is an item that comes after you've actually got the net profit. When you have computed the net profit, it's something that comes next. So it means this revaluation gain will be taken to the balance sheet and equity component. It's an equity component that will come there as a revaluation in the balance sheet for 2016. So that's basically what we wanted from that. And we can try to look at maybe this one. I can add things. This one is coming as a revaluation gain. What I don't want you guys to get confused is the market value, or the fair value, and the revaluation. They are more or less estimated market prices. So you don't get confused from there. So we try now to look at the third property, which was buildings. Third property, which is buildings, the building they constructed. This one we don't need to explain anything because we've actually given a highlight. I've given you a highlight of what's supposed to be done. Because if the land one is accounted for under, if the land two is accounted for under PPE, it means even the building is going to be accounted for under PPE, because this building is on that land. It is already accounted for under. So there is no need for that one to explain. You just take the cost, its cost. The cost one was 120 million. And we are seeing that the purpose, of course, even the purpose was for head office. Purpose was head office. And we have also the depreciation. Here, this one is a depreciable asset, so we need to depreciate it. The depreciation, they told us, is 5% in the question. So the depreciation was 5%. Then this one, even if you don't write, but if you want, you could write something and you say the building will be accounted for under IAS 16 because is going to be used as a head office. So let's try to compute the depreciation first. The depreciation, permit me to abbreviate it like that. The depreciation is going to be 5% multiplied by the 120 million. This will give us depreciation expense of 6 million. And this depreciation expense of 6 million will be taken to the income statement as an operating expense. Then we get the carrying amount. Since this one did not increase in value, so we have to get the carrying amount. And we said the carrying amount is going to be the cost minus the depreciation. Our cost was 120 million minus the 6 million. This will give us a figure of 114 million, 114 million. This is what we are going to be taking to the balance sheet as the carrying amount for the building. Actually, this brings to our conclusion, and we are trying to look at now. Let's try to develop the extracts as they wanted them. The extracts, now we start with the extract of statement of financial position. Permit me to use an abbreviation. Statement of profit. Profit or loss. And other comprehensive income. This is what I've been calling OCI, comprehensive income. This is for the year. For the year ended 31st December 2016. Then we have the other incomes. Other incomes after gross profit. We have the other fair value. The fair value gain that we got from the investment property, that is land 1. The figure was 17.25 million. Then we look also for the expenses. Have to look for the expenses. These expenses will have depreciation. This depreciation we have just computed. The depreciation we computed of 6 million. And from there we go to the OCI after getting the gross profit. Of course, we go to the OCI and you put the revaluation gain. The revaluation gain that was land 2. Which was 12 million. And that's what they wanted for. That was the extract they wanted. Then we also make the extract for the balance sheet. Extract of statement of financial position. Permit me to use SFP as at 31st December 2016. We may start with the PPE, property, plant and equipment. Within the PPE, we have 2 items. One, we have the land we have this land 2, land 1292 million, and the building. The building, which is 114 million. Then we go to the other item, which is the investment property. On the investment property, we had on the that land 1. This was land 1. And the carrying amount of that land 1 was 132.25 million. Then there is one item that is missing, which is the equity section. Can we go to financed by have equity, and under equity we have evaluation gain or surplus. They call it evaluation surplus of 12 million. And that's basically what they wanted us to do for that number. And when you have done all that, be able to get all the marks. That's what basically we were supposed to do. And that's what we were supposed to do for that number. So that's it. Till we meet again, because the next one is going to be on how these assets, how are they going to be changing if at all the purpose of the asset is changing. And we had an investment property today, and we are converting that asset maybe to owner occupation, or we are converting the asset to being inventory. So those are the items we are going to be looking at in the next video. So if at all this video has been useful to you, make sure you subscribe, share to others. They also have a benefit, because what we are doing here is a step-by-step understanding of some of the complicated aspects of counting, and we are breaking them slowly, so that you can be able to achieve, match, and pass CPA with your first trial. So thank you for watching, and let's meet in the next video. It's bye for now.